Let's jump right into this explainer and unpack the wild tug of war happening right now with American Assets Trust, or AAT. If you follow the real estate investment trust space at all, you've probably seen that the current market is throwing off some seriously mixed signals. But AAT, it is a fascinating case study right now. On one side, we're seeing massive, super confident insider buying. But then, on the flip side, major Wall Street firms and quantitative analysts are out here waving some massive red flags. So, who's actually right? Let's break it down.
Here's our roadmap for today. First, we're going to meet AAT and break down their Q1 earnings. After that, we'll track this massive insider buying spree, dive into Wall Street's bearish outlook, and finally, we'll assess the stock's actual fair value.
Starting off with Section 1, meet American Assets Trust, a diversified REIT. Let's look at the operational reality on the ground as of Q1 2026. AAT operates in high barrier-to-entry markets, places like California, Texas, Hawaii, and they are posting some incredibly strong numbers. I mean, look at retail. It's sitting at a near-perfect 97.7% leased. Multifamily housing, solidly at 94.7%. And their Waikiki hotel property is running at nearly 92% occupancy. The only real drag, well, slight drag on the whole portfolio is the office sector, which is sitting at 84.5% leased. Now, I want you to keep that 84.5% figure in the back of your mind, all right? Because it's going to become a major talking point for analysts later on.
Here's a quick look at their outstanding common stock. AAT has just over 61.3 million shares out there. Grasping the scale of this share count is absolutely crucial before we move into their, honestly, somewhat confusing recent earnings report. It just helps us ground all those per-share metrics we're about to evaluate.
Moving right along to Section 2, breaking down Q1 earnings, illusion versus reality. Okay, the absolute crucial point here is understanding the difference between GAAP net income and FFO. Now, GAAP net income, which we all know is standard accounting, it includes non-cash items like depreciation plus one-time property sales. But as you probably know, in the real estate world, buildings usually appreciate, or at least hold their value. They don't just depreciate to zero. That is exactly why we rely on FFO, or funds from operations. FFO adds back that depreciation and strips out those one-time sales. It essentially measures the actual recurring cash being generated by the REIT's core operations. It's literally the lifeblood metric for a company like AAT. So why does this distinction matter so much right now? Well, if you were just casually looking at GAAP net income, you would see it plummeted. I mean, it dropped from $42.5 million in Q1 2025 down to just $5.1 million in Q1 2026. On paper, that looks terrifying. But actually, it's a total illusion. That massive drop is almost entirely because back in Q1 of 2025, they had a $44.5 million gain from selling the Del Monte Center. That one-time gain simply fell off the books this year. When you actually look at the real operational metric, our buddy FFO, it remained incredibly stable at 51 cents per share. That's just a single penny shy of the 52 cents they posted in the exact same quarter last year. And to back up this whole narrative of operational stability, AAT's same-store cash net operating income was practically flat at roughly $66.4 million. On top of that, they expanded their revolving credit facility up to $600 million and pushed the maturity date all the way out to 2030. That gives them some fantastic liquidity. And to top it all off, management reaffirmed their FFO guidance for the full year, targeting between $1.96 and $2.10 per share. Basically, the core engine of this company is humming along just fine. Which brings us to Section 3, the insider buying spree, following the smart money. When the people who know a company inside and out start writing multi-million-dollar checks, the market definitely pays attention. Case in point here is Ernest Rady, AIT's chairman and CEO. He has been on this aggressive, highly systematic buying spree throughout the first half of 2026. We're talking a 10,000 share purchase in May at around $22.67. Then, boom, another 10,000 shares in June at roughly $24. By mid-2026, Rady had accumulated nearly 560,000 total shares for the year. And the craziest part? He didn't stop buying as the price went up. He just kept accumulating, even as the stock kept pushing higher toward its 52-week highs. To really put this into perspective for you, these are far from his only shares. Rady already controls over 13.4 million indirect shares through family trusts and entities. Think about that. When an insider with that kind of massive exposure continues buying up near a $24 price point, it sends an incredibly powerful bull signal. So what is he seeing that we aren't? Well, he's likely looking at those strong rent collections in multifamily, the robust tourism that's boosting their Hawaiian hotel property, and he's locking in a seriously incredible dividend. At these prices, AAT is paying out a 9.09% dividend yield. Essentially, he's getting paid, and paid very well, to just sit back and wait for the broader market to realize the value he clearly sees.
But let's flip it over to Section 4, Wall Street's bearish outlook, the other side of the coin.
Because while the CEO is out there buying with both hands, Wall Street is singing a totally different, much more pessimistic tune. Morgan Stanley actually downgraded AAT earlier in the year. They explicitly cited refinancing headwinds and pushed the stock down to underweight, based entirely on West Coast office fundamentals. Remember that 84.5% office lease rate I told you to keep in the back of your mind? Yeah, that's exactly what has Wall Street so spooked. The prevailing narrative here is that West Coast tech hubs are still really struggling with the whole return to office transition. And with interest rates sitting where they are, refinancing the debt on those specific office properties, it could get pretty painful. And you can see this fear translating directly into their valuation models. Morgan Stanley originally had a $19 price target on AAT. Then, during the downgrade, they slashed it to $17. Now, okay, they did slightly bump that target back up to $18 following the recent earnings reports, but they have firmly maintained that underweight rating. I mean, an $18 target is a massive, glaring disconnect from where the stock is actually trading right now, which is hovering right around $25. Wall Street clearly sees a whole lot of downside risk here. So let's look at the math in Section 5, assessing AAT's fair value from the quant perspective. Looking at Stotz Alpha's performance budget allocation here, AAT is heavily weighted toward profitability at 40% and safety at 34%. And that makes sense, right? They've got a really strong liquidity position compared to their peers. But their growth metrics are sitting right in the bottom tier at just 26%. Their year-over-year revenue and FFO growth are just lagging behind the median for the broader REIT sector. So bottom line, they are safe, they are profitable, but they are absolutely not a growth engine right now. And because of that severe lack of projected growth, well, brace yourselves for this one. Based purely on their proprietary models, Stats Alpha has assigned AAT a base fair value of just $7. Seriously, let that sink in for a second. $7. That means the quants view this exact same stock, the one currently trading around $25 a share on the open market, as being 72% overvalued. From a strictly mathematical, historical growth-based standpoint, Stats Alpha sees a stock that has just vastly outrun its actual fundamental value. They rate its valuation as exceptionally poor compared to the rest of the REIT sector. So the ultimate question you really have to ask yourself after looking at all this data is, who actually has the right read on AAT? Do you trust the on-the-ground operational stability, those near-perfect retail lease rates, and a CEO who is quite literally bubbling down with millions of his own dollars to capture a juicy 9% yield? Or do you heed the very loud, very mathematical warnings of Wall Street analysts and quantitative algorithms who look at this and see massive West Coast office risks and a staggering 72% overvaluation? It is a textbook battle of divergent signals. But understanding both sides of this equation, that's the only way we make an informed decision. Thanks for joining me for this explainer. What's your take on this fascinating standoff? Let that sink in and keep your eyes peeled to see how this all resolves.